Good afternoon, everyone. I would like to call the meeting of the Finance Committee to order, please. Doug, are there any public speakers?
Yes, sir. We have two public speakers today. We have Jason Pinero and Murray Bowden.
Good afternoon, Finance Committee. Good afternoon, Mr. Schwartz. My discussion today will be on budget. We know that all the agencies are having equipment issues. We should add more money towards that. And not only that, giving an upgrade to our infrastructure. We know that our subway system is over a century old. It needs attention. And it is time to dedicate more effort on that. Because we could be financially not in a good shape, but we could do some improvements. Right, Freddie? I hope that you're taking notes, because I'll be giving you signs on Wednesday. So let's do our best.
Thank you. Murray Bowden is next.
I just want to acknowledge how much the MTA has changed in the last few months and is continuing to change. The changes are obvious. A couple of suggestions I have that there is no other place to make them but here. The 2-minute time limit that you post or speak about probably goes back to Virgil Conway's time when he was chair of the board, and there were 30 or 40 people. Gene Rushinoff was here today, and he used to bring lots and lots of people, and so they limited it 2 minutes. I was at New Jersey Transit on Tuesday, and there were 2 times to speak, 5 minutes before agenda items and then 5 minutes after. I have a meeting scheduled with Tim Mulligan from Bridges and Tunnels, and we're going to go out on the road and look at those things that I've been talking about. I took a ride with Bill Finch, the executive director of the Thruway, for an hour with his director of emergency services, and he saw those things on the road, and he said, we're actually doing those things? That's not safe anymore. And so I found that actually going out with the people who are at the top actually does make change. I'll be meeting with Mitch sometime in June to look at some various issues that are that he's aware of, but standing on the road and looking at them together will bring change. Metro North has been doing some things that are not been in the best interest of the riding public. They've been buying railroad married pairs that go back 50 years because trains were broken all the time, and they can't stop doing it and buy units of 4 units and save the installation of 4 cabs and the maintenance and everything else, and it's been impossible to do anything with that. But mostly I want to express my opinion that there is change. There is obvious change. There is obvious cooperation that wasn't here last year. There are people listening differently who actually understand what I'm talking about. I really want out of here. I've had enough of this talking. I have a responsibility because people keep saying to me, keep going, you're the only one that speaks up like that. I don't want to do this anymore. But there is change coming, and I will be out of here as soon as I can. I don't want to do this anymore. Thank you all for listening.
Thank you for your remarks. And that concludes our public speakers.
Thank you, Doug. Next, we have the approval of the April 24th minutes. May I have a motion? Second? Do you have a second?
Second.
All those in favor? Aye. Doug, can you take us through the work plan now?
Yeah, we have no change to the work plan. The next item is Budget Watch. This month's Budget Watch, we're going to focus on operating results through April and subsidy cash results through May. So I'm going to start with operating results for April. Passenger revenues are $1.6 billion below budget in April, and that increased the unfavorable year-to-date variance to $26.8 million. The year-to-date variance reflects adverse weather during the first quarter, in particular the impact of Stella in March. With regard to April itself, that variance mainly reflects low bus ridership at NYCT and MTA Bus that was partially offset by favorable subway ridership. Commuter revenue was basically on target for the month and slightly unfavorable year-to-date. Toll revenue was unfavorable in April, reflecting a lower average toll due to higher Easy Pass usage. That was discussed at the B&T meeting that just concluded. Year-to-date toll revenue is pretty much on target. With regard to expenses, preliminary expenses in April were $55 million favorable, and that increased the year-to-date favorable variance to $138 million, or 3.5%. Now, energy costs are driving some of this favorable result. However, a lot of that favorable variance is timing, so we would expect to see some higher spending later in the year, so we can't really count on all of that favorable result. Within the expense totals were overtime expenses that for the month were $5.9 million, or 11.3% unfavorable, primarily the higher result of overtime at NYCT. Year-to-date overtime results, which also reflect the impact of Stella in March, were $99.9 million, or 7.9% unfavorable. Moving to debt service costs, they were unfavorable for the month, but that was really the result of a pre-funding that was initially scheduled for May, so it's really an unfavorable timing that will ultimately reverse itself. Year-to-date debt service costs remain favorable due to lower than budgeted variable interest rates and a favorable $32 million timing variance from 2016. Moving to subsidies, subsidies through May were unfavorable by $47 million. PMT receipts were favorable by $46 million. However, they offset only about half of the $85 million shortfall in real estate transaction tax collections. We've been talking about that. We had a positive month of January, which was $31 million favorable, but May marks a fourth consecutive month of weak real estate-related tax collections. So I'm going to summarize now, and we're characterizing the results overall as mixed but slightly positive if you net them all out. So on the positive side, we've experienced lower spending on expenses for operations and debt service. As I said, some of that timing delay will erode. We've also had positive PMT collections. Those are running favorable. On the negative side, passenger revenue has come in below budget every month, although a significant portion of that was due to the weather. So we're not running that poorly on a regular basis. Real estate, as I said, we keep talking about that. That's our biggest concern right now. We've had 4-week collection, 4 months in a row. So right now we're looking at all these numbers, and we'll be getting back to you in July with a revised mid-year forecast and 5-year financial plan. Be happy to take any questions.
Doug, with respect to the real estate transfer tax, are we going to have a plan in place since you see a trend going on? If in July you still see a negative trend, are we going to start now working on a plan now to be able to figure out some of the additional operating expense savings in order to address that revenue?
Yeah, we obviously are not going to put our heads in the sand, and we're going to, as accurately as we can, try to forecast that not only this year but going forward. We work with New York City because they're very close to these numbers. So the New York City piece of those numbers are forecasted by New York City OMB. We look at that, and then with regard to the counties, We have other means of doing it, but we're going to capture those trends and we're going to move them forward, and we're going to present a plan that, reacts to that. We have no choice.
Is there any thinking about what's going on in the market out there that's creating this downward trend?
You want to? Yeah.
Bloomberg's been reporting that there's just a significant downturn year over year in terms of commercial property sales. I think it said 58% is the difference between first quarter this year, first quarter last year. If you recall, there had been a lot of international buying, foreign money coming in. I think that seems to be, lessening. And also, I think people are just trying to see what's going to happen with our economy, with the change in administration in Washington. So, we're not sure if this is going to be a trend, but certainly right now, people are not as aggressive as they were. So,
given the volatility of some of these dedicated revenue sources, such as the real estate taxes, just a comment, I think it's even more important that we get the full support from the state, such as in the payroll mobility tax. Moving forward, obviously, we got $65 million less in replacement funds this budget cycle on the operating side. But it's just important to note that this is the delicate balance that you all and we all are grappling with all the time, and it's important to have those sources and the full amounts of those sources replenished and given.
Yeah, and as I reported, we actually are doing well in PMT, and the good news is that the state will authorize even greater numbers than they expect to get, appropriate, I should say, so that if those numbers were to continue coming in higher, those numbers would be out, those dollars would come to us. So that's a bright side of this.
Okay. You want to keep going?
With no more questions, next would be Finance Watch, and Marcia Tanyan is here in place of Pat McCoy. Thanks.
Good afternoon, everyone. Before we talk, Finance Watch begins on page 20. Before we talk about the transactions, I just wanted to make a note that on April 28th, we completed our annual disclosure filings as required by SEC Rule 15C2-12, and it's a very big undertaking. We're working with the operating agencies, staff from many departments in HQ, working on looking at the drafts and due diligence calls. We just wanted to say thank you to all of them for all of that effort, and especially for the Disclosure Council, Hawkins, Delafield, and Wood, who led that effort, along with our internal Deputy General Counsel, Isabel Guerra. So thanks to all for helping us do that. Moving on to our transactions, we just closed last week on a dedicated tax fund green bonds transaction, Series 2017B. That was to retire $350 million of the outstanding DTF bond anticipation notes, as well as due to a favorable market, we went ahead with a refunding portion, which was $371 million for the refunding side. Total issuance was $680.3 million. For the refunded bonds, the present value savings on that refunded par was $35.87 million, or 9.27% of refunded par. We had good retail and institutional investor response. The all-in true interest cost for the entire issuance was 3.63%. The book running senior manager was Ramirez, and special co-senior managers were Academy Securities, a service-disabled veteran-owned firm, Alamo Capital, a WBE firm, and the MBE joint venture team of PNC Capital Markets and the Williams Capital Group. The BIC, the state BIC waiver, the state BIC fee was waived on the refunding portion. And just to reiterate something that Pat has talked about, we are getting close to capacity on the dedicated tax fund, and I think you've asked about that before. This was the last of what we would call the new money transactions for dedicated tax fund for a while. The the transactions that you'll hear going forward, at least for a while, will be remarketings or refundings if we have a refunding opportunity. And I do have two remarketings that I'm going to go into right now. One remarketing that will be closing this week is a remarketing of dedicated tax fund bonds that are currently as SIFMA floating rate notes, and they'll be remarketed as SIFMA floating rate notes. The pricing occurred via competitive bid, and Bank of America Merrill Lynch won that bid. The bonds are going to be remarketed as 5-year term floating rate notes at SIFMA plus 45 basis points. Then some upcoming transactions. We have one dedicated tax fund variable rate bond subseries 2008A-1. It's currently provided by a letter of credit by RBC. It's going to be substituted by a letter of credit by TD Bank. Pat will report on that in the June meeting. And also in June, we'll have the transportation revenue bonds, anticipation notes, another transaction which provides the proceeds go to the approved transit and commuter projects. And Pat will report on that in more detail in June as well. Last, we have a fuel hedge to report. On April 27th, MTA executed a 2.89 million gallon ultra-low sulfur diesel fuel hedge with Goldman Sachs and J. Aron at an all-in price of 1.5915 per gallon. All of the commodity counterparties participated. That was Goldman Sachs, J.P. Morgan, Cargill Incorporated, and the Macquarie Group. The hedge covers the period from April 2018 through March 2019. And I'm happy to take any questions. That's the end of Finance Watch.
Doug?
Okay, thank you, Marcia. Next, we're moving to headquarter and all agency items, and there are two action items. The first is the payroll mobility tax bond resolution for submission to the Capital Program Review Board. Those materials can be found on page 30. And so what we're seeking from the committee is to obtain committee and MTA board approval of the resolution authorizing the submission of the draft payroll mobility tax obligation resolution, standard resolution provisions, and supplemental resolution provisions to the Capital Program Review Board for approval. Upon approval by the CPRB, the full set of credit documents will be resubmitted to this Finance Committee and the MTA Board for formal adoption. And Marcia is here if you have any specific questions about this.
Questions? Motion, please. Second. All those in favor? Aye. Anybody opposed?
Okay. The next action item is the approval of outside counsel. The MTA Office of the General Counsel requests board approval to enter into retainer agreements based on a competitive request for proposal process on behalf of the MTA and its affiliates and subsidiaries with the attorneys and law firms identified on attachment A to the staff summary on pages 201 through 205. These firms and attorneys will provide legal services at competitive rates on an as-needed basis in specific areas of expertise where the retention of outside counsel may be necessary.
Questions? Motion? Second. All those in favor? Opposed?
We have two report and information items. First is to advise the board of the station maintenance billings for the period April 1, 2016 to March 31st, 2017. This is detailed on pages 206 to 210. Billings that total $166.1 million reflect a net increase in the CPI factor for the 12-month period ending March 31st, 2017. That was 2.403%. And that results in a $3.9 billion increase over the prior year's billed amount. That was just for your information. Any? Yes, sir.
Do we get, or I'm sure you do, regular reports as to which counties are up to date on their billings and which are?
Yes, we do. In fact, in October we report on the collections for the year, which have been very good, 100% actually.
Oh, great.
Yeah.
Thank you.
Okay. Yep.
They're very good because state law allows the controller of the state of New York to take out of their sales tax revenue any money owed to the MTA for station maintenance. So I'm sure they're 100% payment because one way or the other you're going to pay. That was put into the law when we enacted the station maintenance back in the 70s.
But they did pay.
And they do pay, that's right.
Okay. And we have one more information report, and it's the annual pension fund report. And Sean Crawford is here to present that.
Hi, good afternoon. I'm Sean Crawford. I'm a Chief Investment Officer, and I'm joined by Margaret Connor, Senior Director of Human Resources and Retirement Programs. I'm happy to provide the annual update for the retirement programs and the retirement funds. So I'll generally keep this brief, and if there are any questions, I'll be happy to address them as they come up. The first is the pension plans are in great shape from my point of view. The pension plans now have $6.6 billion in combined assets between LIRR, Defined Benefit Plan of MTA, and MABSTOA, $5.3 billion in deferred comp. That program has grown dramatically over the past few years as we've done significant upgrades and changes to the investment lineup and the experience for the participants. The plans in 2016 outperformed targets, outperformed the peer groups, outperformed the markets, and it was done in a way that was consistent with our conservative approach in previous years. The funding levels did dip a little bit, and you'll see that in a slide or two later, and that was mostly due to performance in previous years being under targets, RWAs, and salary increases being higher than expected by the actuaries. Again, we remain conservatively positioned and allocated, and so far this year we're up about 5% net of fees through April. So it's been a good 2 years so far for the plans. This is an overview of what we offer here, and it's really to show that it's a very complex platform of retirement options or retirement plans. Apart from what we manage internally, both on defined benefit and deferred compensation, we also have external plans that we contribute into at NYSER's Railroad Retirement Board. And you can see that the expenses to the external plans are actually higher than the expenses to the internal plans. And we've been following a very determined contribution schedule that's been determined by the actuaries, and that we rigorously adhere to it. And one note is that we, when we can, put extra money into the plans. In 2015, LIRR received an additional $70 million contribution. In 2016, it was $145 million, and that is to help close that funding gap that you'll see a few slides later on. Well, the remote seems to have not cooperate with me right now. So on the next slide, which is a market overview, which I can't actually get to. The brief statement on 2016 was that it was a very good year for stocks in the U.S., not a great year for bonds, not a great year for stocks outside the U.S. And from my point of view, it's going to be very difficult to generate returns going forward. Valuations are high, volatility is incredibly low, leverage is increasing, and in my view, this is a recipe for some tail event that's actually probably going to occur in the future. We're not thinking about risk right now. Central bank bailout has been helping investors not really think about risk. Me personally, I'm actually always thinking about risk and risk about loss. So we are continue to position conservatively for these events, and we expect there to be divergence in the markets with central banks pulling out, reducing liquidity. This is going to be a time for active management to shine. We have positioned we both have positions in passive and active managers in our fund in order to be prudent. And this is our asset allocation, and really it's just to illustrate that we are highly diversified. We don't bet on one market, one place. We have a very well-rounded portfolio that, if I could highlight some differences with the peer groups, is we're lighter in equities and in real estate. And we are not looking to increase our private equity or private credit exposures, which is generally what's going on in the public plan universe. Those are ways that you can get to your target returns, but you're taking on a lot more risk, a lot more illiquidity, and you're paying much higher fees. And we're of a different view of that than the rest of the market. Again, performance, our plans are in the blue bars. Had a great 2016, but that was after a relatively just disappointing 14 and 15. So I feel like we're on a good track now in terms of how we've repositioned the portfolio, the types of investments that we have, our asset allocation. I feel very, very comfortable with where we are today. And this is longer-term performance versus the peer groups. And really what you can see is that we've underperformed the peer groups over a longer period of time, and that's really because of our underweight to equities, and equities have been great since the financial crisis. But one thing that I really hope everyone takes away from this is that we manage the plans with a lot less risk. So our plans have a lot less volatility, a lot less risk than the peer groups and than the markets, and that's really by design. And that's something I don't think we're going to change at any point in the future, especially now. The assumptions remain consistent, and again, to highlight, we have a 7% return target, which puts us in the bottom quartile of the public plan universe. The average plan at the end of 16 had a 7.5 target return. We're seeing the universe come down to us. So I think over time there'll be a lot more plans that have a 7% return target than a 7.5 or an 8. But this is an evolution that the market's really forcing on plans going forward. And this is the illustration of the funding status. As you can see, it's improved dramatically since 2010. But we took a little dip this year, and hopefully, just on the mechanics of this, we use a 3-year smoothing on performance. So performance flows through this relatively slowly. So as we start to generate better returns, we'll start to slowly see an improvement within these numbers. And then my final comments will be on NWBE. We will be approaching $1 billion in NWBE assets managed this year. At the end of first quarter, which you'll see that report later on today, we were in, I think, about $75 million higher than this number at year end. And that's a combination of both market appreciation and new investments and alternative investments, particularly real estate and private equity manager. And we continue to be out engaging with the universe, with consultants, with prime brokers, with banks, with every firm that we could engage with to try to source new investment talent, find the best investment talent that we can to manage these plans, and it's a never-ending process. So I expect to see continued development within this over the next couple of years. And with that concludes my prepared comments. I'm happy to answer any questions.
Okay, thank you.
One quick question. Do you happen to know what the NYSER's funding level is?
New York City is, I think it's around 68%. I think it's in the same ballpark as ours.
Okay, thank you.
Yeah. That is now 7%. They brought that down in the last 12 months, if not a little bit longer.
Next are procurements, and Weil Hibry is here to discuss those.
Good afternoon. For headquarters, there are 4 procurements for a grand total of $42.2 million. Those are on pages 211 to 221 of your board books. One is a non-competitive for a total of $25.8 million, and 2 are competitive for a total of $14 million. We also have a ratification for $2.3 million. The non-competitive staff summary is on page 213 of the committee book. It is for $25.7 million, and it requests approval to award a consolidated all-agency amendment to various non-competitive board-approved agreements with Oracle America, Inc. for software, hardware support, maintenance, and subscription services for a period of 36 months, starting May 30th, 2017 to May 29, 2020. The newly created agreement will consolidate all existing Oracle agreements purchased outside of the enterprise license agreement and will formalize Oracle PeopleSoft software, Sun Legacy hardware, Oracle subscriptions, Oracle Siebel, Oracle Primavera, Oracle Linux, Oracle cloud-based products such as RightNow, CRM, SRM, and other Oracle products under one agreement. The amendment will preserve all the terms and conditions from previously negotiated contracts and will ensure a zero escalation over the 3-year term. Further, the MTA is able to drop any licenses that are for systems that we can eliminate as part of our application rationalization effort as part of consolidated IT. This favorable pricing is a result of previously negotiated terms by MTA headquarters back in 2007 under the base enterprise licensing agreement contract. Furthermore, this consolidated amendment aligns contracts currently managed by the consolidated IT department, captures all of the Oracle licenses, support, hardware, and subscriptions across the entire agencies, and terminates all support and subscriptions, making it easier to manage and achieve discounts and contract terms. At the end of the 3-year period, it's MTA HQ's intention to solicit a new competitive contract for these services where possible. The first competitive staff summary for $1.2 million recommends that the board approve the award of a competitively negotiated multi-agency personal services contract to CH2M Hill to provide consulting services for the development of crew dispatching and timekeeping system for New York City Transit, Long Island Railroad, and Metro North Railroad. Crew data are supplemented with near-term adjustments to schedule and personnel assignments. Consulting services are needed to develop a detailed technical scope of work that will assist us in evaluating proposals and selecting a vendor via a subsequent RFP. The second competitive staff summary is for $12.9 million for Choice Distribution, Inc. It's on pages 216 and 219 of the committee book. It recommends that we exercise a second of a 2-year option for an approved contract spanning from June 1, 2017 to May 31, 2018. This modification is required to support the ongoing needs for hardware and fasteners required for railroad cars, subway cars, and buses, as well as expansion of rail, subway shops, and facilities requirements. The MTA has added many new and different types and styles of buses to its fleet and is operating more buses past their 12-year replacement mark than anticipated. Metro North has since added 405 M8 fleet rail cars, and Long Island Railroad's fleet of 937 M8 rail cars have been coming out of warranties, which impacts our contract spend. The unit prices as established in the base contract will remain the same and are deemed fair and reasonable.
Any questions? Jim?
That Oracle agreement, do you happen to know what the spend was in prior years for those disparate contracts that now aggregate into this single contract?
The maintenance is relatively a stable amount year on year because it's a percentage of the annual cost. So basically, if it is 42, it's the 1/3 of the $42.2 million. The difference between the prior agreement and the new agreement I'm recommending is the zero escalation cost going forward.
So we haven't gone up notably or down notably on the maintenance cost?
On the maintenance, no. It's a percentage of the license cost.
And do you know what percentage there?
We have been acquiring additional software products because we're expanding the use of PeopleSoft at the Business Service Center and in the agencies, but that would be new licenses rather than the old maintenance.
Okay, but is there a singular percentage, an actual percent?
The percentage on the enterprise licensing agreement, which is the base percentage, is 18%.
Okay.
However, when we buy software in smaller quantities, our maintenance is usually higher than 18%.
Okay, thank you.
Do you have a motion? Second? All those in favor? Aye. Opposed?
One abstention on Sage term.
Duly noted.
Mr. Chairman, we have one ratification to award a miscellaneous procurement contract for $2.3 million, and we recommend the Finance Committee ratify the award of a contract to Carasoft Technology Corporation writing the New York State OGS contract PT 66623. This is for the design, implementation, and support of an open source content management system for the B Division countdown clocks for 30 months, retroactively from October 2016 to April 2019.
Any questions? Motion? Second. All those in favor? Aye. Opposed?
Next on the agenda, we have Metro North. There are 6 procurements for Metro North for a grand total of $46.3 million. One is a non-competitive procurement for a modification to a miscellaneous service contract for a total of $5 million. 5 are competitive procurements for a total of $41.2 million. 4 are requests to use the RFP process. 3 are jointly with Long Island Railroad. 1 is a request to award a 3-year competitively bid and negotiated public works contract.
Questions? Motion? Second. All those in favor? Opposed?
For Long Island Railroad, there is 1 non-competitive miscellaneous procurement for an intergovernmental lease agreement for the lease of 8 to 21 passenger coach cars for a total of $4.1 million. The base is $670,000 with 2 one-year options totaling $3.489 million.
What? Okay. I like that. Second. All those in favor? Opposed? Okay.
Next, we have New York City Transit and MTA bus operations. There are 3 procurements for a grand total of $16.4 million. 1 is a non-competitive procurement for testing and evaluating new technologies for detecting and warning of intrusions by persons or objects onto the subway tracks in station areas for a total of $1.68 million. 2 are competitive procurements for contract modifications for a total of $14.7 million.
Questions? Second. All those in favor? Aye. Opposed?
Abstain on CH2M.
For bridges and tunnels, there are 3 competitive procurements for modifications to existing agreements for miscellaneous services and additional funding for a grand total of $11 million.
Questions? Motion? Second. All those in favor? Opposed?
This concludes the procurements, Mr. Chairman. Now to Doug.
Thanks, Wael. So next we have the First Mutual Transportation Assurance Company's annual presentation to the board, and Phyllis Rackmuth is here to present it.
Good afternoon, everybody. I'm here with Nora Ostrovsky, who's our Director of Strategic Initiatives, to go over the FIMTAC annual report. The annual report was made available to you before today, and it includes the audited financial statements, the actuarial report, and the investment report. This is an important year for us. First Mutual Transportation Assurance Company, or as we call it, FIMTAC, is celebrating its 20th anniversary. We're the first licensed captive insurer in New York State, and we started in 1997 with $3 million in funding from the MTA, which we were able to pay back by the following summer of 1998. Today, we have assets in excess of $560 million, which we use to provide insurance coverage and programs across all the agencies. We're here to discuss our 2 major programs, first one being the Excess Liability Fund, and then our biggest program, the property program that we have. The Excess Liability Fund provides $50 million per occurrence coverage above the agency's self-insured retentions. The larger agencies, the railroads, transit, MTA bus, have self-insured retentions of $11 million. Sertoa, B&T, headquarters have retentions of $3.2 million. And by way of an example, FIMTAC, fully reserved for Metro North Spuyten-Duyvil derailment, and we've been able to reimburse Metro North the full $50 million that they've paid out in claims. For property insurance, each agency has a self-insured retention of $25 million. FIMTAC provides coverage excess of that with $800 million of limits. Even though the program renews May 1, we start strategizing and working on putting together all the underwriting information in January. In the aftermath of the Sandy storm, we had approximately $5 billion of claims, and we found the capacity the following May severely constrained in the conventional insurance market, and the pricing went up significantly. Through alternative risk financing, we were successful in securing additional limits and CAT coverage. That was the summer we did the original MetroCat transaction. Currently, we've seen the domestic market, or the U.S. market participation, since then has gone from about 48% on our program down to 14%, and we've had one major carrier totally walk away in the metropolitan area. We've put a significant amount of time and effort over the last 5 years to increase capacity for our program and to reduce the premium rates. As you know, it took us time to settle the Sandy claim. Now it's settled, and we're in a more favorable cycle, a softer cycle with the insurance rates with the market. MetroCat matured in July 2016, and we did come to the board for authorization to enter into another insurance-linked security transaction. The ability to obtain the capital markets-based reinsurance has proved to be an economically successful alternative for FIMTAC because we're no longer solely dependent on traditional reinsurance. Nora and I worked on the transactions, and I'm going to turn it over to Nora to discuss some of the strategies.
Thanks. So we just wanted to kind of explain a little bit what the approach is and what the strategy is and how it all comes together. As Phyllis said, our property insurance program is the biggest program for FIMTAC. It's expensive to purchase property insurance for the MTA, became very expensive after Sandy, and so just wanted to tell you a little bit about how we work to bring those rates back down. So as you know, just to remind you, there are two sources of capital for property reinsurance. So on the left side of the chart, we are showing traditional reinsurance markets. And again, as Phyllis mentioned, domestic participation went down dramatically after Sandy. So we're actually purchasing property insurance all around the world. So there's London market, Bermuda, Asia. We go everywhere to get the best rates. So then on the other side of it, there are capital markets where the market for insurance-linked securities developed over the last couple decades and became an increasingly important source of capital for the property reinsurance. That's insurance-linked securities, so-called cat bonds investors, and also sort of standalone funds with whom we can do like sort of like one-on-one standalone contracts. So those markets are very different in terms of what they're looking for. Traditional markets provide all risk coverage. It's backed by their balance sheet. They're very heavily regulated. So for their purposes, they're looking for specific amount of any kind of regional risk in their portfolio. On the other side, capital markets basically provide catastrophe coverage. So they are addressing mostly three catastrophic risks that can be modeled, which is the risks associated with hurricanes such as wind and surge, and also the earthquake risks. Those investors provide collateralized coverage, so they put up collateral to the amount of risk that they cover. And for them, there are sort of like two different groups there. There are hedge funds and pension funds who invest in cat bonds because of the high yield that those investments can provide for them. In the low interest rate environment that we're currently in, that's increasingly attractive to them. And then there are specialized cat bond funds, and for those Also, they're looking to diversify. Our risk happens to be a big diversifier because it's very regionally focused, as opposed to sort of like Florida wind risk or California earthquake risk. So what we're trying to do every year is to create this tension, create competition, both inside each market, but also between the two markets. So this is just supposed to sort of like give you a glimpse into, it looks like a patchwork, like a quilt, right? And when we start the process, as Phyllis probably mentioned, we start in January to be able to kind of put the program together by May. There are kind of pieces, it's almost like mosaic, right? There are all these investors and everybody is looking for something that works for them, and we're trying to put it together so that we can provide best coverage to the MTA at the lowest possible rate. The color coding here is by market. The truth of the matter is that inside each market there are syndicates, there are multiple firms. So for instance, this particular program this year, we had 53 participants in traditional markets. And some of them are looking for the risk exposure sort of across all layers of the program. So the bottom layers are the layers with the most risk. That's where we get coverage right above our retention. And then as you go higher and higher up, basically if you think about the risk that can create 500 million worth of damage, 600 million worth of damage, that will be mostly catastrophic risk, right? That's what happened during Sandy. So if you look at the extreme right of this sort of like patchwork that we're showing, you see this gray vertical. That's a traditional insurance company looking for exposure across all the layers, top to bottom. Then, for instance, if you look at the lower left-hand corner, bottom, you see like this green area. This is London Syndicate, and they were looking just for the exposure in this primary 250 million area. Like in the middle, you see this little kind of orange patch. That's an investor from Zurich, traditional insurance company, who was looking for an exposure in that particular layer. So somebody who is looking for a specific risk profile can provide actually better rate than somebody else who is not as interested. We're trying to match supply and demand to sort of the market. The traditional market is reasonably non-transparent. Sometimes you see swings in the rates that traditional companies are trying to charge within 70, 100 basis points. So we're trying to move those offers kind of around, again, to obtain the best rate for the MTA. And then, of course, in this top layer, 200 in excess of 600 is the top layer where we're trying to place our second MetroCat transaction. Just to give you a sense, last year in that layer we had 8 participants in that one layer. This year we had 7 participants in MetroCat. Now MetroCat was placed in capital markets where we had over 20 investors participating. So we were able to increase competition for that particular layer, where we were able to push some traditional investors down into the tower where we needed sort of more participation, more capacity, and better rates. And we placed MetroCat at a very attractive rate in the capital markets because of the competition for risk that we were able to create. And I will turn it back to Phyllis to talk a little bit more about the results.
Okay, so as Nora and I had said, we came to the board, we got permission to do the ILS transaction, which we moved ahead with doing the next MetroCat for $125 million. We have $675 million of traditional coverage, and then the $125 million in MetroCat. We were able to get a 15% savings this year. We went from 43 million down to about 37 million. And we'd say about half of that was just due to the further we get away from Sandy, a softening market, the claims settled, about 6 to 8%. But the rest of it was due to the strategy that we used with the MTA team to look at all options available. Do we have any questions? Includes our presentation.
Thank you.
Yeah. Next is real estate. Jeff Rosen's here.
Thanks, Doug. Do we have a quorum? Are we okay? Yeah. Okay. Thanks. We have 4 action items this month. 3 of the staff summaries are on director's desk with apologies. 1 is in hard copy in front of you and will be added to director's desk. I think 2 of the items are worthy of mention. First, in March, we asked the board and received authorization to proceed with a funding agreement for $100 million to contribute toward the redevelopment of Moynihan Station. Or the redevelopment of the Farley Post Office for Moynihan Station. We are now asking for authorization to consummate the financing of the transaction, a multi-party closing, which we hope will occur in the middle of June. The MTA's role, apart from the $100 million direct financing, includes entering into a lease agreement with ESDC for Empire State Development for a condominium unit to be occupied by the MTA and the station. And additionally, as described in the staff summary, we've been asked to, as an accommodation, to provide credit support for TIFIA financing that ESD expects to be obtaining in time for this financial closing. If there are any questions about that, Barbara, I would be glad to answer them. Otherwise, would ask for approval.
Motion? Second? All those in favor? Aye. Opposed?
Okay. The other is, those of us who are working on this, believe me, literally cannot wait to share with you the results of our competition for our advertising contract. It's truly very exciting. We are going to be leveraging hundreds of millions of dollars of private investment that will not only transform our advertising largely to digital, but significantly enhance our customer communication capability. But we are not quite ready to announce that result. We're asking for an additional 90 days to complete contract negotiations under competition, as we believe that's in the best interest of the agency. Unless there are questions, I would ask for approval of that item as well, and the other 2 that are in the books.
Thank you, Mr. Ferrer.
Mr. Chairman. Sure. The issue on the communication, we've had this conversation before, and I just want to make sure we are clear. The additional communication efforts that are going to be made for our customers with regard to information to them will apply not just to our main terminals, but will also apply to the outlying stations.
That's correct.
And that we will be able to use, we meaning MTA or our agencies, will be able to use those facilities to provide updated information regarding our uses directly to the customers.
That's exactly right, Mitch, and it's on a agency-wide basis as well.
Thank you.
Motion? Second. All those in favor? Aye. Opposed? I'm going to ask for a motion to adjourn. Second. All those in favor? Meeting adjourned. Thank you.